What's going on, everybody? Cullen Gandy here. So today I want to talk about what an adjustable rate mortgage is, or an ARM, and everything that goes into it, because there's several different factors and variables that go into creating an adjustable rate mortgage, and as a result, there's a whole long list of pros and cons when it comes to your financial situation. So if you're considering an ARM for yourself, or perhaps your clients, you're going to want to stick around because I'm going to tell you everything about them. So what is an ARM, or an adjustable rate mortgage? Well, an adjustable rate mortgage is simply any mortgage that has a period where there's a fluctuation in the interest rate. The reason that an ARM fluctuates is because they use benchmarks to peg their interest rates, and so they are thus dependent on the variable prices of those indices at a given point in time. Because of this fact, these loans are generally considered to be more risky than your traditional 30-year loan or any other kind of fixed-rate conventional mortgage. That being said, usually there are parameters and limits within which these adjustable rate mortgages are capped, so there is a movement that you can go to, but you can't go outside of. So you're going to know what you're getting into at least a little bit before you get into it. Generally, the reason that most people are interested in adjustable rate mortgages, especially hybrid mortgages, which we'll get to a little bit later, is because the initial interest rate on offer is usually more attractive. In fact, often they call this the teaser rate. So what are the different kinds of ARM products out there, and how do they work? Well, the first and the most common type of ARM is going to be called the hybrid adjustable rate mortgage. Hybrid simply means that there is a mix between an initial fixed rate period and then a periodic adjustable rate thereafter. When you're looking at a hybrid ARM, you're usually going to see a series of numbers and slashes, usually number slash other number, right? And that's going to correspond to your initial fixed rate period, followed by the number of recurring time periods when your rate is going to adjust. So for example, you might see something like a 5-1 ARM, or a 5-6 ARM, or a 7-1 ARM. In this case, that just means that the first period is going to be a number of years, and then the recurring periods are going to go in intervals of whatever the second number is. For a 5-1 ARM, that first fixed rate period is going to be a period of 5 years. That means that you're going to be making the same payment on that teaser rate for 5 years. And then when it switches to that 6th year, that's when the adjustable rate is going to kick in. And that's when the new interest rate from the index that is tied to your adjustable rate mortgage, that's when that's going to kick in. So again, that's 5 years fixed, and then every year after that, your benchmark is going to change, and your rate is going to either increase or decrease depending on what these indices say. Usually that second number is a reference to a year-long period or a number of years. But if you see something like a 5-6 ARM, that can reference like a 6-month period too. So it's not always standard, but usually you can bank that it's a year-long adjustable period. One really important piece of information when you're considering an ARM for yourself or your clients is the cap, right? Because the cap is going to be the parameters in which your interest rate is going to be able to move around. There are different types of cap limits. You can have caps with respect to the rate. You can have caps with respect to the payment, right? But these are going to be delineated during the negotiation process for your ARM. And to add a little bit more confusion to the mix, these are also delineated with numbers and slashes. This time, there's going to be 3 numbers separated by 2 slashes. So when you're looking at your cap, that first number that you're going to see is going to be the first adjustment cap for your first adjustment period, right? So after you have that first initial fixed rate period, then during your first adjustment, that's the cap that your index will be able to pull you up to and not go beyond. So let's say that first number is 5. That means during your first adjustment, your rate will not be able to exceed a 5% jump over that first year. The second number is going to be in reference to how the interest rate can float up or down in each successive adjustment period. So let's say it's a 2, right? That means that your rate will be able to go up or down only by 2% before it's capped. And then finally, that third number that you're looking at is going to be the total cap for the life of the loan. That means you cannot go above that many interest rate point jump. So we're going to say we have a 7-2-7 cap structure. And let's say you have a 5-1 ARM. That means on your 6th year, which is going to be your first adjustment year, you will not be able to jump more than 7%, right? So let's say the indices go wild and it goes up by 10%. don't worry, it's never going to go up more than 7% that first adjustment period. Then you go on to the second adjustment period and it goes down by 3% or up by 3%. Well, you're never going to be able to move more than 2%. And then eventually, let's say during the life of the loan, it exceeds 7%, right? So it never really jumped 7% in the first case, but eventually did make it over that hump. Well, you're still not going to be able to be adjusted more than 7% increase over that life of that loan. Now the other two ARM products are going to be the interest-only ARM and the payment option ARM, and both of those have a little bit different objectives. So when we're referencing an interest-only loan, it's going to be exactly that. There's going to be a long period where you're going to only be paying the interest that you've taken out on this loan. And usually that's going to be a period of about 10 years. And then after that period, you're going to be responsible for the principal and the interest. This is a loan that's especially inviting for business people or entrepreneurs, self-employed folks who want to get a little bit more cash flow in, but want to take care of their housing needs or their investment needs. But because they're paying that interest only for such a long time, that principal is going untouched really for about a decade. So that can be pretty daunting when you start making your principal payments 10 years down the road. But again, this can be really attractive if you want to refinance it and you want to keep that, that cash flow coming in. If you're a short-term or a medium-term thinker, this can be a really attractive offer for you. Now the payment option ARM I would consider to be one of the more risky of the three types of ARMs. This is because this is the most negotiable loan that you can get in the ARM product space. You see, you can often negotiate with these payment option ARMs a payment that is lower than the interest. So it's effectively less payment per month than even in an interest-only loan. But because of this, there's going to be a long period of where you're having what's called negative amortization, where the actual balance of the loan is increasing over time. So this is a very strategic loan and one that you're going to be using for very specific reasons, right? Now with all those loan products being wrapped up, it merits saying, how do you calculate what an ARM actually is? How does it work? How does it function? Well, we as mortgage loan originators have a really simple formula for what goes into an ARM. And that is simply the note rate, or the rate that we are offering you, consists of the margin, that's the rate that we negotiate with you, plus the index rate. That's tied to that benchmark that I was talking about. What does that mean? What are these indexes that we're talking about? And how do they serve as a benchmark that we can use to help manipulate the price of your loan? Well, there are three major indices that we're talking about when we're talking about these benchmarks for your ARM. So number one on our list of indices, we have the 1-year Treasury Bill weekly maturity yield. This is just the index that follows what the Treasury is paying out to people who purchase bonds that the Treasury is selling. Another popular index is what's called the COFI, or the Cost of Funds Index. And this is a similar index that is used in the 11th District on the West Coast of the United States to help negotiate what funds actually go for. But the benchmark that's most popular by far nowadays is what's called the SOFR, or the Secured Overnight Financing Rate. And this has replaced the LIBOR, or the London Interbank Offering Rate. So let's go into a little bit of an exercise into what pricing ARMs actually looks like. Let's say we as a lender negotiate a marginal rate of 2% on this loan. And then we tie that margin to the SOFR index, which is currently going at, I think, 4.3%. That means that you're getting an initial fixed interest rate, a note rate, of 6.3%. But then 6 years down the road, when your next adjustment kicks in, let's say the SOFR is at 5%. That means that your new interest rate that you're going to be paying is going to be 7%, assuming that the cap for that year is less than what the actual interest rate ends up being. Which, if I'm honest, it's probably not going to be like 0.5% more than what you're actually paying, so I think you're still going to be on the hook for that. So whatever the SOFR goes up by, just so long as it's under the cap, it's going to be on you to pay the difference. It's going to be on you to pay whatever that interest rate ends up being. But it also goes the other way. Let's say the SOFR goes down 2% in the next adjustment period. Well, your rate is actually going to go down 2% according to that initial second number for the adjustment. If that's within your periodic movement caps, then you're going to be able to get a little bit of a discount on what you had the year prior. So as you can see, an adjustable rate mortgage is a little bit more technical. There's a little bit more that goes into an ARM. But if you're comfortable with a little bit more risk, or if you just think that you have a little bit of a penchant for speculating on what different markets are going to be doing in the next couple of years, maybe this is the loan for you. Also, if you're a business person, you're looking for a little bit more cash flow, or you want to use money elsewhere where you can get a better return on it, this is something that I get a lot of business people and self-employed people asking me about. Anyways, I hope this video was helpful for you guys, and if you enjoyed it, please leave me a like and subscribe to my channel. It really would help me out immensely. And until next time, I hope we end up a little bit happier and a little bit richer. Peace, guys.